Hi, everyone. I'm here with Philip Petursson, our Chief Investment Officer. It's been about 6 months since we last talked with Philip. And the one thing that I could say, Philip, is that, as much as things change, they also remain the same. Okay? And, the economies today are incredibly complex. When we look back through history, there's so many changes and tools that are available. And I would say for the average person, is a ton of complexity because what we see and hear today in the news only talks about what we think may happen versus what we actually know is happening. So before I get going, I recognize that last time when I introduced you, I actually didn't do a full bio on you. And instead of me reading it, do you mind just taking a couple of minutes and let's just talk a little bit about your history and how you ended up being the Chief Investment Officer at IG?
Well, certainly. And, thanks for having me on again. I do appreciate the opportunity to speak to you and everyone that has joined us today. Yes, I've been with IG now a little over a year. I came from another company in the industry where I spent 22 years, the last 15 of which as chief investment strategist over there. And I've been almost 30 years in the business overall. So I've seen a lot of market cycles, lived through a lot of bear markets and recoveries, and I've got the scars to prove it. I would say this just to understand a little bit of what I do. It's to really make sense of where we are in the economic cycle, the market cycle, and to recognize the opportunities in front of us that perhaps, what we don't want to do is let them slip by. And so if we can position ourselves, whether that be through advice or the portfolios that I manage on behalf of IG, just to try and gain a little bit more, get us closer to our goals, that's ultimately what I try and do on any given day.
Yeah, thank you, Philip. And by the way, thanks for correcting me, Chief Investment Strategist, because I think I said Chief Investment Officer. I apologize.
They're almost the same.
Yeah, exactly. Well, the one thing that I know is that I can't believe a year has already gone by without question. But in my career, I've never actually had an opportunity to have such a great relationship and somebody that is so approachable. And what I do find is that when you do talk, it's meaningful. Because like you say, it's a big picture overview. And while I know that you have a lot of data to share, the essence of this conversation is to help provide some confidence, right? Because knowledge is in fact confidence. And I don't ask me why I thought of this, but it's not that I'm a Charles Dickens fan, but I have no idea. But there was a book called The Tale of Two Cities, and the opening line, and again, I have no idea why I remember this, it was the best of times and it was the worst of times. And I was reflecting on that and some of the things that you and I have talked about, because even if I go back, 2 years ago at the start of pandemic, we would have called that the worst of times, followed by really the best of times. And then here we are today, returning to what you have coined, and I do believe as well, is really a return to normalization. So would you be able to just give us an overview, just in general, of where you think we are in our economic cycles around the world today?
Certainly. And, I'll relate it to almost like a New Year's Eve party. You have the build up to New Year's Eve. And really that was coming out of COVID, where we had, I would say, a rapid reopen of the global economies in Canada, the United States, and around the world that was supported by trillions upon trillions of fiscal and monetary stimulus. So, Rod, during the COVID lockdowns, you could walk down the middle of downtown Toronto, and there was no one on the street, and shops were closed. And so the government and central banks around the world recognized that in order to avoid what could have become an economic depression, they needed to provide some type of monetary and fiscal stimulus. And that amounted to about $16 trillion over the course of 2020 and 2021. And so think of it like leading up to the party. You have all the catering, you have a fantastic bar set up, and everyone is enjoying themselves to the nth degree. And that's exactly what happened in 2021 with the stock markets and real estate markets and you name it that went up. Well, now we're dealing with the hangover of that very, very loud and excessive party, which was great while it lasted. But so what I mean by that is you cannot just put in all of this fiscal and monetary stimulus without there being some type of payback. Well, that payback is higher inflation that leads to higher interest rates, which is now a slower economic growth environment that we're moving into in the first half of 2023. But yeah, this is all a return to normal. Now, this is an economic cycle that's probably been truncated over the course of what would have normally been 10 years down to, call it 3. But nonetheless, that's what we're going through. And I think your quote is very, very appropriate for right now, where you say it was the best of times, it was the worst of times, because there are aspects of this economy that haven't been better in a long, long time. Jobs are very plentiful in this country. The unemployment rate in Canada is near multi-decade lows. Similarly, in the United States, people are still to have the power in terms of the labor force that they can work, they can choose to work wherever they want, and they know they're going to get paid well for that. That's the best of times aspect, and the worst of times is the inflation that potentially creates, and the market volatility that has come as a response or consequence to the inflation. But back to the return to normalcy, as we get through this period, and let's be honest, we can see signs of recessionary pressures building into 2023. No one's surprised by that. When I speak to clients and say, look, I think there's a decent probability that we're headed towards a recession, does that surprise anyone? No one is saying, yes, I'm shocked to hear that. And so I think it will be very manageable. It might be more a mathematical recession than a broad-based economic that would impact a large percentage of the population. But it's all in this kind of return to a normal environment that we see forthcoming, whether it be the economic cycle, whether it be the market cycle, towards the back half of 2023.
Yeah, well said. And I'm glad you touched on the employment because, as a person with an economics degree, which means I know a little bit, right? Which is dangerous at times, of course. But we live in a consumer-driven society. And of course, if people are working, typically then have free cash flow. And while rising interest rates should mute that spending of the cash flow, it's because it's been excessive, right? Would you agree?
Yeah. Absolutely. One of the quotes that I've been using is from William Simon. He was U.S. Treasury Secretary during Richard Nixon's administration when inflation in the United States was just starting to take off. And he said, people hate inflation, but love everything that causes it. So what causes inflation? Demand, consumption, wages going up. These are the things that have caused inflation, but they hate inflation itself because everything costs more.
Yeah, and what this does, and I can tell because as we're talking with clients, and there's so much emotion naturally around, and it's fear, of course, because we've had a tremendous fall this year in markets that people, whether they remember or not, they feel like they've never really seen this before. But to me, it comes with a lot of unease because when they look around, and you touched on it, you don't see unemployment lines, you don't see manufacturing closing, you don't see the roads empty, you don't hear people, they're worried about buying, they're losing their homes, et cetera. So there's a massive disconnect between how the market behaves and where the economic cycle is. And I'd love you to touch on that because it also makes timing the market really almost impossible for those reasons.
Exactly. And people think that, we're headed towards a recession, therefore the market is going to get worse. Well, markets tend to be very forward looking. So I would argue that the volatility that we've seen over the last 6 months is a reaction to the economic weakness potential that we have going into 2023. And this is the way it works. Markets tend to peak well before a recession, bottom at some point during the recession, but recover well before the recession ends. And so to your point, in terms of trying to time the market, I'm getting that question now from clients saying, well, wouldn't it be better just to move to cash and wait for the markets to recover? It's like, well, if you had perfect foresight in terms of when that recovery would start, then certainly you could avoid some of the downside. But I don't have that. I've been in this business almost 30 years. And while you can recognize a bottoming process, and I think we're in one right now, trying to get the exact timing of that is impossible.
Yeah, and we're also very fortunate because we invest globally, and we also, we have, very diversified portfolios across multi different asset classes. And, the interest rates are having one of the greatest impacts in what we call the fixed income component, right? Particularly around what people have always perceived, to be very safe, things like bonds. But in fact, fixed income is a much broader spectrum than that. And can you touch a little bit on if any opportunities that you see on the fixed income side today?
Well, absolutely. And this is one of the more interesting aspects to the market in that when bonds are down, it's usually a function of interest rates moving up. And we've come from a period of time when bonds were returning effectively zero. Or, if you go back about, 4 years, you had trillions in bonds that were yielding negative interest rates, or basically you were paying the borrower to lend them money. That's all kind of gone the other way now. But as we go from an interest rate policy that is effectively zero for the Bank of Canada or for the Federal Reserve to one where we're at 3.25% for the overnight rate for the Bank of Canada, going from 0 to 3.25, that's when you see a significant drop in the value of a bond, right? So the bond price is inverse to interest rates. But because we started at 0, we had no coupon to offset some of the price drop. And so that's where over the last year, the return on bonds has actually been very, very challenged. It's been anywhere between, in some cases, -10, -15%. And it's been across the bond spectrum. But now things have changed. And now the bond environment is much more attractive because we're looking at yields between 3.5% and 9% for bonds. And so if you want to get a sense of what a bond fund or a bond is going to earn you, look at the yield. And that tells you roughly what you're going to get with some upside over the course of the next usually 8 years. And so with bond yields, an average bond portfolio paying, call it 5.5%. Now that's an attractive yield. We have to forget about where we've just come from, because if we started in 2018, interest rates were above 3%, government bond yields were above 3%, went down to 0, back to 3%. So that was an uncomfortable ride. But the gains, the disproportionate gains made just before COVID or into COVID were given up post-COVID. Now we're back to that normalized word, we're in a normalized environment where bonds are paying us something to hold them again, to lend people money. And I believe that they're going to return to that downside protective nature in our portfolios that, if we do head into recession, it's not a foregone conclusion, but if we do head into recession next year and we see a little bit more weakness out of the equity markets, well, the offset will be bonds, as opposed to earlier this year where both bonds and equities were down.
Yeah, it's an interesting viewpoint, Philip, and I totally agree. I was thinking that, for many of our clients, if they're retired or close to retired, they're going to be in a balanced portfolio typically, or even more conservative. And that has been a terrible experience over the last 6 months with the interest rates and, like you described, with the bond values decreasing. But it also sounds to me like there's now tremendous opportunity in that area going forward. And in fact, based on what I just heard you say, it's possible then that the bond actually returns could in the short term actually be more attractive than the equity side. Am I right?
Yeah, absolutely. The question of we can go back a year ago or a couple of years ago, and people were saying, is the 60-40 portfolio dead? That's the 60% equity, 40% fixed income. And the answer is no. It's just it works very well at some times and works less well in others. The last 6 months has been very challenging because almost every single equity market has been down and every single bond market has been down. Gold has been down, even those that flock to crypto down. So there hasn't been a lot that's actually worked well over the last 6 months, but that's behind us. And we're always trying to look forward. And I use the windshield versus the rear view mirror analogy, right? The reason why your rear view mirror is so much smaller than your windshield, because it's more important to know where you're going than where you've been. And so when we look forward, now we can see bonds that are providing an attractive return. And in fact, to your point, over the course of the next year, I would say the potential for bond returns is very similar to what we think US equities can return. But the downside risk in bonds is much lower than what could be potential downside for US equities. So similar upside, but much better downside protection. So yes, that's return to a 60-40 portfolio, I think will reward investors over the coming year to 2 years.
Yeah, wonderful. Yeah. And so tell me a little bit about the asset allocation, which, is the terminology really of just, the shifting of money between different assets. I mean, if I could simplify it, right? Tell me a little bit about what your thoughts are today about opportunities and where you are shifting and advising that we shift the portfolios internally.
Certainly, and I'll put it in the context of what I'm doing within the funds that I manage, where recognizing that we are heading towards an economic soft patch. What I want to do is minimize any potential downside risk, or that's not eliminate. All right, so the keyword there is minimize, not eliminate. And so what that means is adding incrementally to bonds, to fixed income, in areas that we find are attractive, that are offering attractive yields, and reducing some of the equity exposure, in particular in the US. Now, I want to define what that means. It doesn't mean we're taking our US equity weight down to zero or cutting it in half. It means we're trimming it back and shifting to areas that have less downside and potentially more upside. So what does this look like? It looks like Canada, right? The TSX is trading at very, very attractive valuation, and very interesting, Rod. The TSX is approximately down 12% year to date. A little bit a little bit more than a third of that has come from one stock alone, that's Shopify. Yeah, if you strip Shopify out of that, then the TSX is only down about 7%. So still negative, but negative by much less. Now, why is that? Why has the TSX significantly outperformed the US equity market year to date? It's because the valuation of our market is much cheaper than what we see in the United States. And we're levered to areas that weren't expensive, weren't driven much higher because of some cyclical forces of all the money coming in particular, energy. With oil kind of normalizing into this $80 range, plus or minus $10, that's been very, very good for our energy producers. The banks are very healthy. So all in, the TSX is an attractive place to be. So that's one area that we're looking at. Another area is international markets. So Europe, for example, Europe is probably further along in terms of its economic weakness. And everyone that you would talk to would say Europe's a mess as far as the economy goes. And they have issues in terms of energy, where they were so reliant on Russian natural gas for electricity. We know that, and that's already priced in. And Europe is trading at about a 40% discount to US equities. Right? Wow. So here's another emerging markets, right? China has suffered through economic weakness because of its zero COVID policy, right? I bought a fridge months ago. I'm still waiting for it to be delivered. I have no idea where in the world it is. But that has resulted in the emerging market index trading at a 50% discount to US equities. And so as we start to see the economies actually reopen through this economic soft patch, these areas should do well just because of the attractiveness in terms of valuation.
Yeah, well said. And again, that's the beauty of having these, globally diversified portfolios like we do, because we're not restricted in that area. So we can actually now, with a magnifying glass, look at the globe as a whole and look for those opportunities like you've described. When I hear, 50% decline, I think, okay, there is an opportunity there. Sure. Timing, again, that's up to you guys. But what I really do feel very comfortable with is that the timing between when a recession starts and what the markets do are not absolutely correlated. And that's all I mean, everybody has an opinion right now, that's for sure. And I don't think anybody thinks in the news anyway that there isn't a recession coming. But as we talk about, there's different sizes of recessions. There's little R's and big R's, and there's some that you may not even notice, as a matter of fact, right? And even though it's technical. Is that an accurate phase for today, do you think?
Absolutely. I think when we look at the potential for economic weakness into 2023, we would classify it more as a little r recession, predominantly in the United States. Canada is a little bit different, but Canada isn't as important to the stock market as the US economy is. So we really would classify it as little r. The labor market is still fairly healthy. We'll see a little bit of unemployment creep in, but I don't think we're going to get to anywhere near what we saw in 2008, where the unemployment rate or labor market shed 5 million jobs at that point. I don't think that's going to be the case in the United States this go around. And when you mention about the timing of the market versus the economic cycle, a typical recessionary bear market is a drop of 36%. But during a recession, the drop in the S&P 500 typically is only 7%. So that tells you that, again, the market's forward looking. And that's average. So that includes all the bad recessions, 73, 74, 80, 82, 2008 and 2009. And we don't think that we're headed towards that because those also coincided with a financial collapse of some kind. And we don't see that on the horizon. So we believe that, from the market perspective, we're at least 2/3, if not 90% of the way through, this bear market. And there are signs again that indicate that perhaps the market is trying to form a bottom. Either we're there or close to it. That could open up great opportunity into 2023.
Well, before we go, thank you again, Philip. But before I'm going to let you go, there is an indicator which I've always loved, by the way, and it's really the fear index, right? The investor sentiment index, because it's always contrarian. So I'm going to let you run with that. Tell everybody what it is, and also what your feeling is on it.
Well, certainly. And there's a number of different ones that we look at. One of the ones is the University of Michigan Consumer Sentiment that measures the overall consumer sentiment in the economy. There's the AAII, which is the American Association of Institutional Investors. It's a bull bear survey. How confident are investors feeling with respect to the stock market? I like to look at money flows as well. In terms of what are investors in the United States doing? Are they buying stocks or selling stocks? And in each case, we've hit extreme levels. So for example, the University of Michigan Consumer Sentiment hit an extreme level in July that we hadn't seen in 40 years. That is usually indicative of strong markets to come. So when we are at our most pessimistic is when we should be greedy and putting money to work. So we've seen that with the AAII bull bear survey as well. Bear sentiment hit a peak just a few weeks ago. That tends to coincide with market bottoms. The volatility index, the VIX, is a gauge of fear that's priced into the market. That continues to hit peak levels. And then coming back to the money flows. I've seen since May, we've had over $200 billion come out of equity and balanced funds in the United States. Numbers like that tend to coincide with bottomings of markets. So there are a lot of signs out there. Now, we never know for sure until well after the fact, but there are a number of signs out there. And plus, Rod, perhaps you're getting the same thing where I'm getting questions from clients saying, should I go to cash? Usually when you're getting those kind of calls, we're near a bottom.
That's my experience as well. Yeah, it is. And, well said again, Philip. I really appreciate the time, and I hope that we can do this again in a few months just to keep us updated, because again, it's, the worst, it's been the best of times, but also the worst of times. But I think we can probably use that every calendar year, as a matter of fact, because there is always something good and there is always something that's bad. Unfortunately, it's our news that's reporting the bad, but you're here to tell us a little bit about the good. So wanted to thank you again so much.
It's a great pleasure, Rod. Thank you for having me.